In 2006, Spain was in the midst of an economic boom, with spectacular growth since the turn of the millennium. The economy doubled in 6 years and was projected to surpass Germany in per capita income. The Eurozone facilitated international investment, and the real estate sector became a great business opportunity, with agents and construction workers earning huge sums. However, this boom was a debt-driven bubble, and when the global and Eurozone financial crises hit, the economy collapsed. Today, Spain continues to struggle with high levels of unemployment, a stagnant economy, and housing affordability problems, highlighting the risks of over-indebtedness without learning from the past. Currently, in 2024, although the Spanish economy has shown some signs of recovery after the COVID-19 pandemic, it continues to face significant challenges. Inflation, although more controlled than in 2022, continues to affect the purchasing power of families, and the cost of living has increased considerably. In addition, the housing situation remains problematic, especially in large cities such as Madrid and Barcelona, where rental and purchase prices remain inaccessible to many young people, despite government attempts to implement rent control policies and improve access to affordable housing. The labor market also remains a challenge. Although the unemployment rate has decreased compared to the crisis years, it still remains above the European average, especially with regard to youth employment. Recent labor reform policies have sought to reduce precariousness and encourage permanent contracts, with some success in reducing temporary contracts, but job insecurity still persists. The transformation towards a greener and more digital economy is also a key objective of the government, with EU recovery funds playing a crucial role in financing these projects. Although the implementation of these changes remains slow. The rapid growth of the Spanish economy was fueled by the entry into the Eurozone and market liberalization, which facilitated international investment. The belief in continued economic growth attracted large sums of money to the real estate market, generating a self-fulfilling prophecy of growth and prosperity. The global financial crisis and the Eurozone crisis burst this debt bubble, causing a sharp decline. Since then, the economy has remained stagnant due to several factors: high levels of debt, a labor market with high unemployment, especially youth unemployment, and the lack of structural reforms to improve economic activity and housing affordability. In addition, the slowdown in the global economy and Spain's dependence on affected sectors, such as construction, contributed to the lack of recovery. Today in 2024, the situation remains challenging. Although the country has received EU recovery funds to revive the economy, the impact of these funds has been uneven. Some regions and sectors have managed to take advantage of these investments, while other areas, especially those more dependent on construction, continue to suffer from economic stagnation. At the labor level, the 2022 reform helped to somewhat reduce the temporality of contracts, but the jobs available are often of low quality and opportunities for young people are limited. In addition, inflation and the rising cost of living have complicated the situation for many families, exacerbating economic inequality. As for other major economies, some are in more compromised positions today than Spain was in 2007. Countries with high levels of debt, dependence on the real estate market, or unstable financial systems could face similar risks if they do not learn from the lessons of the Spanish crisis. The economic history of Spain has been a constant roller coaster, from the mismanagement of colonial wealth to being excluded from the Marshall Plan and the first liberalization policies. The country has had repetitive cycles of boom and bust. The growth of the 1990s, which was an apparent success, began with entry into the European Economic Community, EEC, seeking to integrate the economy and reduce the high unemployment rates of that time. Since the pandemic, there has been a resurgence of the tourism sector, one of the fundamental pillars of the Spanish economy. But this resurgence has been volatile due to the global situation and changes in traveler behavior. In the long term, the need for a more diversified economy and less dependent on tourism and construction remains a central challenge that the country has yet to resolve. Spain's entry into the European Economic Community in 1986 did not have promising immediate results, as its GDP per capita remained below average. However, after a recession in the early 1990s, the Spanish government managed to reduce inflation and, by the middle of the decade, begin to reduce unemployment. The integration of the EEC into the European Union and the adoption of the euro in 1999 offered both advantages and disadvantages. Currently, Spain's GDP per capita has shown an upward trend compared to the years after joining the EEC, but growth has been affected by the 2008 financial crisis and more recently by the COVID-19 pandemic. However, the country is beginning to recover, with sectors such as tourism and the service industry being key drivers of the economy in the post-pandemic stage. On the one hand, the adoption of the euro allowed Spain to benefit from a stronger and more stable currency, which facilitated trade with other European countries, simplified price comparisons, and reduced the cost of credit. However, by joining the Eurozone, Spain also lost monetary sovereignty, that is, the ability to adjust its currency and control interest rates to face internal economic challenges. This situation became particularly problematic during the 2008 financial crisis and the Eurozone sovereign debt crisis, when Spain was unable to devalue its currency to stimulate exports and employment. Today, dependence on the common monetary policy of the European Central Bank remains a significant constraint in responding to the specific challenges of the Spanish economy. This context fueled the housing bubble. In 1998, a year before adopting the euro, there was a significant increase in immigration to Spain, which encouraged the government to focus even more on building houses to meet the demand of these new residents. Greater accessibility to cheap credit and the construction boom led to the illusion of solid economic growth, convincing many that Spain was on its way to becoming a Eurozone superpower. However, the 2008 crisis burst the housing bubble, causing a severe recession in the Spanish economy and a significant increase in unemployment. In more recent years, the real estate market has begun to recover, although with more moderate prices and stricter banking regulation. In addition, the current situation, influenced by the war in Ukraine and widespread inflation in Europe, has impacted construction costs and access to credit, complicating a new boom in the real estate sector. The construction boom in Spain was seen as a promising solution to reduce unemployment, as this sector demanded a lot of labor and could keep citizens employed for long periods. At the height of the boom, construction workers could even afford luxury cars, driven by easy credit and access to the euro. Currently, although the construction sector no longer has the weight it had in those years, it is still a relevant component of the economy, especially in the rehabilitation of housing and construction of sustainable infrastructure in line with European green transition policies. The working conditions of workers have changed, with greater regulation to prevent abuse and promote job security, but construction is no longer the main engine of the economy, as it was in the boom years. Cheap credit with low interest rates, favorable government fiscal policies, and the stability of the euro made the Spanish real estate market extremely attractive to investors. The government offered tax breaks that favored the real estate sector, such as deductions for mortgage interest payments and, most notably, the deduction of principal payments from personal income tax. All this encouraged massive indebtedness. Today, fiscal and credit policies are more conservative, and access to mortgage credit is stricter, with a more detailed risk assessment to avoid the repetition of housing bubbles. In addition, the recent rise in interest rates by the European Central Bank in response to inflation has made mortgages more expensive, reducing access to cheap credit that was previously the norm. The reason why the central government did not foresee the problem and investors did not hesitate was, in part, the country's decentralized economic structure. With fiscal decentralization, many financial decisions were in the hands of regional authorities and not the central government, which meant that the magnitude of the debt was not evident in national statistics. This lack of visibility allowed debt to grow without the risks that were accumulating being perceived, ultimately leading to the economic crisis. Currently, measures have been implemented to improve fiscal transparency and coordination between the central government and the autonomous communities. Even so, challenges persist, as decentralization remains a topic of debate, particularly when it comes to harmonizing public investment and resource management in the midst of an interconnected global economy and in the face of recent crises such as the COVID-19 pandemic and energy fluctuations related to the conflict in Ukraine. The Spanish government established a constitution in the 1970s to guarantee the autonomy of the country's regions, creating 17 autonomous communities and 2 autonomous cities in North Africa. The communities manage much of the tax collection, health costs, and education, disconnecting from central control. Currently, the autonomous model continues to evolve, with some communities such as Catalonia and the Basque Country demanding greater powers and even independence. In recent years, there have been significant tensions, such as the unilateral independence referendum in Catalonia in 2017 and negotiations to redefine the framework for regional financing, a pending discussion that affects the distribution of resources between regions. Before the 2008 crisis, Spain had 45 savings banks, cajas, that bet heavily on the real estate sector, creating a construction boom that attracted investment from countries such as Germany and France. At its peak, 12.5% of the workforce was in construction, creating more than half of the new jobs in the European Union. After the crisis, most of the savings banks were absorbed or merged by large banks due to their financial problems. Today, the Spanish financial system is much more consolidated, with fewer entities and greater regulation to avoid the excesses of the past. In addition, the real estate sector has shown signs of recovery, although it faces new challenges such as the rising cost of materials, inflation, and growing concern about housing affordability. Between 2003 and 2008, house prices rose by 71%. Although the Spanish government anticipated a possible fall and collaborated with banks to reserve 35 billion euros, this measure was insufficient to prevent the impact of the looming crisis. Since then, the Spanish real estate market has gone through several stages of adjustment and recovery. Currently, house prices are growing again, especially in urban areas such as Madrid and Barcelona, driven by sustained demand and the interest of foreign investors. However, housing affordability has become a major problem, especially for young people and low-income families, which has led the government to implement measures such as rent subsidies and the promotion of social housing to try to correct these inequalities. The key problems that led to the collapse in Spain included poor communication, overestimation of the number of homes needed, and corruption in the mortgage system. Initial immigration drove excessive housing development, resulting in a surplus of more than 800,000 homes in 2006, when they were really only needed for 200,000 families. Currently, the real estate situation in Spain has improved, but challenges arising from the crisis still persist. The excess of housing has been largely absorbed by demand, although there are areas of the country where developments from the housing bubble remain uninhabited. In addition, problems of access to housing and speculation continue to be critical points, with an increase in public policies focused on limiting rental prices and promoting social housing. In addition, banks and appraisal companies collaborated to manipulate the value of homes. Mortgages had to have a loan-to-value (LTV) ratio of less than 80% to be considered safe. But when the LTV approached 100%, financial workers contacted appraisal companies to increase the value of the home, artificially reducing the LTV. This allowed banks to grant risky mortgages that did not follow established policy, contributing to the bubble and the eventual collapse. Currently, banking regulation in Spain and throughout the European Union has tightened its controls to prevent this type of manipulation. New measures have been introduced, such as the obligation to maintain a higher capital buffer and strict monitoring of valuations by the Bank of Spain. In addition, the development of new technologies, such as blockchain, is beginning to be explored in the financial sector to offer greater transparency and reduce the risks of corruption. The most dangerous risk that banks and financial institutions in Spain took was granting unsecured mortgages to clients with overvalued real estate. 80% of the Spanish population owned homes, but the housing bubble burst and real estate debt reached almost 50% of GDP. Many families were unable to pay their debts and banks were unable to recover losses, as homes were heavily devalued. The 35 billion euro fund was not enough to prevent the collapse. Currently, although the Spanish real estate sector has stabilized, there are still consequences of the 2008 crisis. Recently, housing prices have risen again, raising concerns about the possible emergence of a new bubble. Spanish banks, however, have significantly tightened their lending policies, increasing the requirements for granting mortgages and trying to avoid past mistakes. Inflation has also impacted purchasing power, making it difficult for families to access home ownership. At the regulatory level, the Bank of Spain has increased supervision and implemented new regulations to protect both financial institutions and consumers, mitigating the risk of a similar crisis. The current situation in other countries, such as Australia and Canada, shows similar warning signs: high household debt, fiscal policies that favor real estate investment, speculation fueled by migration, and banks willing to ignore risks. These countries could face situations similar to that of Spain if preventive measures are not taken. In Australia, house prices have begun to stabilize after years of steady increases, but household debt remains one of the highest in the world. This has led the Reserve Bank of Australia to raise interest rates aggressively to try to cool the market. In Canada, the situation is similar. Although the real estate market has shown some slowdown, household debt remains alarmingly high, and fiscal policies still favor investment in property. In addition, both countries face the impact of high immigration, which increases housing demand, and contributes to speculation. The authorities are adopting some preventive measures, such as raising interest rates and tightening mortgage regulations. But experts warn that it may not be enough to avoid a scenario similar to the one Spain experienced in 2008 if they do not act more decisively. The increase in housing prices in Spain in the early 2000s seems modest compared to that of other economies in recent years. Although Spain tried to revive its economy with massive stimuli, greater than those of any other European country, its history of crisis was overshadowed by the financial collapse of Greece in 2009, which diverted international attention. Currently, the Spanish real estate market is showing signs of recovery, with sustained increases in housing prices. However, these increases have raised concerns about affordability, especially among young people, who face difficulties in accessing home ownership due to stagnant wages and precarious working conditions. Government policies have implemented measures to promote access to housing, such as tax incentives and affordable housing programs, although their effectiveness is still under evaluation. Spain continues to face the effects of the housing crisis. Despite some years of growth, its GDP has not yet recovered to 2007 levels, and average wages are below those of countries like France and Germany, with a current average of €29,113 per year, 11% less than before the collapse. Debt and inflation have increased, worsening the financial situation of citizens. In addition, the bank bailout forced the restructuring of most of the Caja savings banks, hindering access to credit. According to recent data, Spain's GDP has shown a positive trend, with a year-on-year growth of 3.4% in the third quarter of 2024, reaching the highest rate in the last year and a half. This growth has been driven mainly by public spending and household consumption. Regarding wages, the average annual salary in 2022 was €26,948, 4.1% more than the previous year. However, significant wage inequalities persist by gender, sector, and region. Public debt remains high, and inflation has shown signs of slowing, although it remains a concern for the domestic economy. The restructuring of savings banks has led to greater bank consolidation, which has affected access to credit for individuals and small businesses. However, policies have been implemented to improve financial inclusion and facilitate access to credit, with results yet to be determined. Spain's adoption of the euro in 1999 brought financial stability, but it also limited the country's ability to adjust its exchange rate in response to economic crises. This restriction, along with the decline in income during the financial crisis, contributed to a significant brain drain, where highly qualified professionals emigrated in search of better opportunities. This phenomenon has negatively affected the country, which needs innovative solutions to revitalize its economy. In addition, unemployment remains high, and many workers depend on temporary jobs to survive. In recent years, Spain has implemented various initiatives to attract and retain talent. One example is the aid program that has facilitated the return of professionals who had emigrated, allowing the reinstatement of 100 scholarship researchers. However, the brain drain remains a concern, especially in regions such as Castilla-La Mancha, Castilla y León, and Extremadura, where the emigration of young people of working age is notable. As for unemployment, although there has been a gradual decrease, the rate is still higher than the European average, and job insecurity persists, with a high percentage of temporary contracts and low-wage jobs. Spain faces an uncertain future, with possibilities of slow recovery, but the collapse should serve as a warning to other countries. Excess debt in a single sector, irrational enthusiasm, and lack of diversification can cause similar crises elsewhere. Portugal, for its part, faces similar challenges but is taking a unique approach to rebuilding its economy, although it has not been entirely popular. Portugal has shown a remarkable economic recovery in recent years. In 2023, the Portuguese economy grew by 2.2% year-on-year in the last quarter, thus avoiding a technical recession. This growth has been driven by prudent fiscal policies and a strategy focused on economic diversification. In addition, the country has implemented structural reforms and has efficiently used European funds to strengthen key sectors. However, some of these approaches have generated internal debate, especially in areas such as labor reform and fiscal policy. Despite criticism, the measures taken have contributed to a faster recovery compared to other countries in the region. And with this, the video concludes. Peace to all.